The polar ratio changes as our position in the cycle changes. If we don't change our investment stance as these factors change, we are being passive to the cycles. In other words, we are missing out on the opportunity to tip the odds in our favor. HOTM. There is an obvious truth that few investors want to face. The market does not operate in a straight line, it breathes, it fluctuates. It alternates between euphoria and pessimism. It is these rhythms, these cycles, that determine the success or failure of an investor mastering the march. The On Your How does not promise a magic formula, nor does it draw accurate day-to-day forecasts. Instead, he suggests a different approach, listening to the cycle, recognizing where you are in the trajectory and adjusting your investment attitude accordingly. Drawing on more than half a century of experience living through market waves, Max demonstrates that understanding cycles is the compass that tilts the odds in our favor. What makes the book special is not its dry definitions but the way it poses questions that force us to think. Why do people always forget old lessons and repeat mistakes? Why does euphoria sow the seeds of recession and failure prepare the way for recovery? Can we learn to go with the cycle instead of letting it wash over us? And perhaps the most important question you'll take with you into the pages that follow is whether, if the cycle is constant, you'll choose to be a victim caught up in the rhythm or someone who knows how to use its rhythm to go further. And before going into the summary, we encourage listeners to buy and read the book to fully experience its content. Because only when you read the whole book will you understand the problems I am telling you about. Please buy the book and support the author. Now let me start summarizing this book. Part 1. Investing is a game of probability, not certainty. When we enter the market, we are betting on the future. But the nature of the future is unknowable. That leaves many people in two extremes, either trying to predict every macro movement or giving up and going with the flow. Both ways are prone to failure. I believe the correct way is to observe the cycle. Cycles are the repeating rhythms of the economy, of profits, of human psychology. They are not as regular as clocks but not completely random either. They are a synthesis of push and pull, of greed and fear, of hope and despair. And it is by recognizing the position in the cycle that we can tilt the balance of probability in our favor. Professional investing is the effort to outperform the average. Generating average returns is easy, but to outperform the crowd, investors must find ways to adjust their strategies as the cyclical landscape changes. I do not believe in the ability to accurately predict the macro future. History shows that very few people have been successful at predicting what the economy or markets will do. As Warren Buffett once said, a piece of information is only truly useful if it is both important and knowable. But macro forecasting often fails to satisfy both conditions, which is important. But rarely does anyone grasp more than the majority. So instead of focusing on forecasting, I focus on what I can know about the fundamentals of the business, the fair price, and especially where it is in the cycle. To visualize, imagine a glass jar containing 100 marbles, 70 of which are black and 30 of which are white. If you don't know the odds, drawing a ball is just a game of chance, but if you know the probability in advance, you have an advantage. Bet on black, you will win more than lose. A good investor is one who, not knowing for sure what will happen, has a superior understanding of the trend and thus tips the scales in his favor. That doesn't mean we'll always be right. Even if we know the probability is 70-30. We still have a 30% chance of being wrong, but with repetition, the probability advantage will pay off. In investing as well, knowledge of cycles does not give us certainty, but it does give us the ability to survive and succeed in the long run. The difference between an average investor and a great investor is the ability to listen to the cycle. Average people see isolated events, exceptional people see patterns. They ask whether we are at the beginning or the end of a growth wave, have profits gone too far, to dangerous levels? Is investor psychology driven by greed or fear? Is the market too hot or too cold to buy? It is through these questions that they know when to be on the defensive and when to be bold in their attacks. A great investor doesn't need to know the exact future, just understand where the cycle is taking us. When the economy and profits are likely to increase, when sentiment is cautious, when prices are not too high, that is when opportunities open up. On the contrary, when the crowd is excited, when risks are underestimated, when everything is praised as infallible, that's when danger lurks. Cycles are a reminder that everything is temporary. Euphoria gives way to pessimism, growth gives way to recession. Investors cannot avoid the storms, but they can learn to steer their ship. That's why I wrote this book, to show that if you listen to the cycle, if you recognize your place in that repeating rhythm, you won't be surprised, you won't be swept away, but you can proactively use the cycle to your advantage. Many people often think of cycles as a series of events following growth followed by recession. After recession comes recovery. But to truly understand, we must not only see them as connecting points but also realize that each event is the cause of the next. When I meet with clients, I often draw a straight line from the bottom left to the top right, which represents the long-term trend of the economy and the market. Then I draw another line that wavy up and down around it, which is the cycle. This curve is never flat but always oscillates around the center point. The cycle can be described as follows. Recovery from low to equilibrium. Cross the equilibrium point. Go to the top. Set the correction peak and return to near equilibrium. Continue to fall below equilibrium. Bottom out and then bounce back, and the process repeats. The important thing is that the cycle has no absolute beginning or end. Any stage can be considered as a beginning or an end depending on how you look at it. That's why when someone asks me if my period is about to start or if it's over, I often find that question inaccurate. The right question should be, where are we? In this rhythm, I often compare the cycle to a pendulum. The pendulum hangs on a balance point, but it always swings to both sides. If we let its suspension point move gradually from left to right, the pendulum's trajectory will become a wavy curve. It's the cycle. Pendulum and period are just two different ways of talking about the same phenomenon. Oscillation around a central level. M was once said to have said, history doesn't repeat itself but it rhymes. This quote, whether he actually said it or not, describes the nature of cycles very accurately. The cycle does not repeat itself exactly, but its rhythm, its reason, always returns. The center point of a cycle is usually a long-term trend such as economic growth or corporate profits. For example, GDP might grow at an average of 2% per year, but fluctuate around that number from year to year. When it's faster, people are happy, when it's slower, people are pessimistic. It is this oscillation that creates the dance of the cycle. It is worth noting that as the cycle moves to an extreme, it creates its own pullback. When the economy does too well, prices climb too high, optimism becomes excessive, that is when the seeds of recession are formed. Conversely, when failure, pessimism and fear are rampant, the seeds of recovery begin to sprout. I often say success contains the seeds of failure. Failure nurtures the seeds of success. The cycle does not simply return to equilibrium but often exceeds it as the market recovers from low prices. It rarely stops at a reasonable level. The jubilation continued, pushing prices further into overdrive. Then comes the time when that very euphoria leads to a crash in life and investments. That is the law of regression to the mean. Everything will be back to normal. But rarely stops at reasonable level. They often swing back and forth to the opposite extreme. The further the cycle moves from equilibrium, the greater the devastation when it returns. A normal recovery only leads to a correction, but an overexuberance will leave behind a violent crash. The further away from the midpoint, the stronger the reversal, the more severe the consequences. Imagine a growing economy, record corporate profits, soaring stock prices. The crowd believes that this time is different, that the old rules are outdated. Then just one small shock, all optimism was blown away. And the naked truth emerges, the cycle never goes away. Cycles are further complicated because they are interconnected. Economic cycles affect profit cycles, profits affect psychology. Psychology governs financial markets, which in turn influence the credit cycle. Then credit comes back to impact the economy. Cycles do not exist in isolation but are interwoven into a complex network where each movement triggers chain reactions. Understanding this, we will realize that observing cycles is not about finding a starting point or an ending point, but about learning to read the rhythm, grasp the trend, and prepare for the next step. If you want to grasp the cycle, you have to accept a paradox. They are both constant and irregular. Constant because there is always repetition, growth then decline, excitement then disappointment. Unusual because each time it is repeated, the details are never exactly the same. It is this combination that causes many people to either believe too much that they can predict accurately or, conversely, to believe that cycles are just an illusion, both extremes being dangerous. I realize that people are the biggest force pushing the cycle away from the equilibrium when things are good. Euphoria lasts longer than reason allows when times are tough. Fear makes the crowd more pessimistic than necessary. Thus, not only objective circumstances but also human psychology creates the weight that makes the pendulum continue to swing. One thing to remember, a cycle is a chain of cause and effect. When an event reaches its climax, it does not stop there but creates the conditions for a reversal. When the market is high, values are inflated, capital is distributed too widely, and risks are underestimated. It is these factors that give rise to the next crash and vice versa. When everything falls into despair, prices hit rock bottom, investment freezes, that is the starting point for a recovery. I often say, success carries with it the seeds of failure. Failure sows the seeds of success. It is not just a philosophical observation but a rule of survival in finance. Because of this, I rarely talk about the beginning or end of a cycle. Those concepts create the illusion that we can precisely mark time. Actually, the cycle has no clear border, it is like a winding river, there is no place where the bend begins, only gradual change that becomes more obvious when we look back. One of the important properties of cycles is that the potential for losses increases as they move further away from equilibrium. A hot market breeds bad behavior, excessive borrowing, and overvaluation. Overconfidence that this time is different. When a reversal occurs, the result is often not just a minor correction but a crash. Conversely, a market that falls too deeply often creates great opportunities because at the bottom the risk has been absorbed and the potential for recovery has accumulated. Examples can be taken from historical financial cycles. The tech bubble of the late 1990s or the global financial crisis of 2007.2008, both show that behind every boom is the seed of collapse and behind every collapse is the opportunity for reconstruction. The most frightening thing is human short-term memory. Kennego Breath pointed out in A Short History of Finance Euphoria. Financial markets have extremely short memories. Yesterday's lessons are easily forgotten. And a new generation full of confidence goes back to the old path. They dismiss history's warnings as outdated, only to repeat the same mistakes in different forms. A sober investor must be aware that history rhymes, the details can change, one time it's real estate, another time it's technology, another time it's subprime. But the core theme never changes. Excessive euphoria leads to collapse and extreme fear paves the way for recovery. This also leads to an important conclusion. Cycles are usually symmetrical, with every boom being balanced by a bust and vice versa. But the symmetry here is only in direction, not in time or degree. A bull run can last for years, while a crash only lasts a few months. But balance is eventually restored. The plunge is often violent because the balloon deflates faster than it fills. As my colleague Stone has said, the recovery could be slow, on the contrary, because it takes time for confidence to return and for the economy to absorb old mistakes. So how to take advantage of this feature? Not by trying to predict the exact timing but by observing the overall trend. Learn to sense when the excitement has gone too far, when the fear has hit rock bottom. That's when it's time to adjust your investment attitude. Be more defensive when the crowd is blind, more courageous when they are desperate. Finally, remember that cycles do not operate in isolation but are interconnected like a network. Economic cycles affect corporate profits, profits affect psychology. Psychology governs the market affects credit. Credit backfires on the economy. It is a complex vortex where everything is interconnected and reflects each other. Realizing this constraint, investors should not look for a fixed formula but rather practice an intuition about cycles, know how to listen, know how to recognize signs and above all, know how to prepare for the inevitable. One constant question I get is, are my periods actually regular? Many believe that to be called a cycle it must resemble the mathematical waveform that rises and falls rhythmically. The amplitude and frequency stabilize and always return to the starting point. If not, it is just random fluctuation. I once had an interesting debate with Nick Tran, a fund manager in London. He argues that investment phenomena should not be called cycles because they lack the precise predictability of physics or mathematics. I agree that markets do not follow mechanical laws, but I argue that while they are irregular, they are still cyclical in nature. Observe human psychology. After excitement comes boredom, after fear comes hope, beliefs and emotions always fluctuate. And that is what makes the market move in a repetitive rhythm. Yes, we cannot measure the peak and bottom accurately like a clock. But denying the cyclicality just because it is irregular is like denying the existence of seasons just because the weather is different every year. This is the key point in investing. Cycles do not come from mathematical formulas but from human beings with their psychology, emotions, short-term memory, and internal conflicts. Because of human involvement, cycles are both recognizable and unpredictable. I remember there was a period in the junk bond market. People spread the 2-year rule. Many bonds typically default within about 2 years of issuance. If that were the real rule, investors simply sell all bonds before the 2-year mark and buy back the ones that survive after this mark. But that's just a statistical illusion. A few coincidences in a short period of time create a seemingly certain pattern. This is proof that human psychology always craves to find simple formulas and often equates randomness with rules. It is important to emphasize that cycles are not exact repetitions but rather recurring trends. When a factor reaches its peak, it creates momentum for a reversal. When the market is too expensive, investors lose money, and that failure opens the way for caution and cheap prices to return. When the market is too cheap, those who dare to enter reap the profits, and that success in turn sows the seeds of new euphoria. A wise investor looks not for certainty but for signs of trend. Let me give you a picture. If we drop a ball into a stream, it will flow in the general direction of the flow. But the waves, the whirlpools, the collisions with the shore will make its trajectory sometimes fast, sometimes slow, sometimes recede, sometimes advance. We can't measure the exact distance, but we know for sure that it won't stay still. Likewise, economies and markets tend to move upward in the long run due to productivity and progress. But around that trend, psychological and random fluctuations create short-term waves. The irregularity in rhythm does not take away from their repetitive nature. There is a truth that many people find difficult to accept. The cycle contains an element of randomness. Humans tend to attribute causes to every effect. Because uncertainty makes us uncomfortable. We want to believe that success and failure have clear reasons. But the reality is, as Leonard Modai Nav writes in Runk Work, randomness is fundamental in life, and finance is no exception. A company can report good earnings but its stock price can fall due to external factors, interest rate changes, a competitor releasing a new product, or simply a general market downturn. Therefore, we should not expect a mechanical formula. The power of cycle research lies elsewhere. It helps us understand that history has rhythm, that euphoria is always followed by fear, and that extreme fear often opens up opportunities to observe history. I see one thing for sure, the market will always continue to go up and down, but I never know exactly when, fast or slow, high or low. What I do know and enough to give me an edge is that the majority of investors understand less about cycles and care less. Just by paying attention, you have an advantage over the crowd. The cycle is not as regular as natural science, but it is still a cycle. And just understanding this nature takes you a long way toward avoiding falling into the trap of blind optimism or extreme fear. If we want to understand cycles, we cannot ignore the economic cycle, the foundation of all other movements in the market. The business cycle is the rhythm of growth and recession across the entire economy, and it creates ripple effects on corporate profits, financial markets, sentiment and credit. Imagine a straight line that slopes upward, representing the long-term growth rate of the economy. That straight line is made up of sustainable factors, population growth, technological progress, and improved labor productivity over many decades. This upward path may slow down but rarely turns back. That is the long-term trend. But around that line is actually a wavy curve. This year the economy grew faster. Other years slow down, occasionally fall into recession and then recover. The average may be 2% correct, but in reality there are 55% and there are 53%. It is this fluctuation that makes investors live in anxiety and excitement. The business cycle can be described by 4 phases: expansion, rising output, strong employment, low interest rates stimulate consumption and investment. Peak, economy operating at full capacity, costs rise, inflation sets in, recession, production falls, unemployment rises, spending shrinks, recovery. After hitting bottom, confidence gradually returned, spending increased, and the economy revived. The special thing is that each stage leads to the next. When the economy expands too long, inflationary pressures and rising costs force the central bank to tighten policy. This increases the cost of borrowing, reduces consumption, and drags the economy into recession, which in turn creates the conditions for recovery. Interest rates fall, costs expire, inventories get cheaper, demand returns, and the cycle never stops. One factor that makes the economic cycle stronger is group psychology. When people believe the economy is growing, they spend more, businesses invest and expand, and banks lend easily. That belief reinforces itself until it becomes too much. When the truth comes back, profits are down, costs are high, confidence is broken and pessimism makes the recession deeper than it needs to be. It can be seen that the economic cycle is not just a story of output and employment but a story of people. Workers spend more when they feel their jobs are secure. Businesses increase investment when profits are abundant. The government believes that growth is the fruit of policy. And then when things turn around, everyone retreats, making the recession worse. Another point is that economic cycles are uneven in time and amplitude. There are decade-long periods of growth like after World War II, but also periods of rapid and deep recessions like the 2008 crisis. This reminds us that we cannot predict with precision, but we can identify when the economy has run too hot, when it has cooled to absurd levels. I remember the years before the 2008 crisis: steady growth, low unemployment, easy credit. It is believed that a new paradigm has emerged, that the old cycle has been eliminated. But in truth, it was that euphoria that sowed the seeds for the crash. And when the crisis hits, people go to the opposite extreme, believing that the economy will never recover. The recovery has actually begun even at the most pessimistic times. Economic cycles are also influenced by demographics and technology. An aging society will have slower growth because of a shrinking workforce. Conversely, technological breakthroughs can increase productivity, pushing the long-term trend line up. But no matter what, fluctuations around that trend always exist because humans never go in a straight line. Understanding the economic cycle doesn't prevent volatility, but it does help prepare us for it. When extending too long, be careful. When the recession is too deep, be patient. Investors cannot control the economy, but they can control their reaction to the waves. And that is the advantage. The economic cycle is complex, but government intervention makes it even more unpredictable. Fiscal and monetary policies are designed to smooth out the fluctuations. But many times, instead of eliminating them, they accidentally amplify the fluctuations. When the economy is in recession, governments often spend more and cut taxes. While central banks cut interest rates and pump in more liquidity, the aim is to stimulate demand and lift the economy off bottom. On the contrary, when growth is too hot and inflation is high, policies are tightened, taxes are increased, spending is cut, and interest rates are raised. This is how the pendulum is adjusted to keep the economy close to equilibrium. However, reality shows that policy is rarely timely. Often government action comes late. As the economy enters a new phase, a strong stimulus package may come when the economy has already recovered and result in an overdose. Push the cycle into new excitement, vice versa. Tightening too much when a recession is already imminent can send the economy deeper into recession. Think back to the 2008 global financial crisis. The credit bubble had been building for years, the continued expansionary policies, low interest rates, excessive credit, and rampant debt all fueled the fire, and when the crisis hit, the government's knee-jerk reaction was to inject massive capital and cut interest rates to near zero. That helps prevent a total collapse but also sows the seeds of new risks, so the cycle is not broken. Just left, it can be said that the government has the ability to reduce the amplitude of oscillation but cannot completely eliminate it. Sometimes the policy even creates additional cycles. As the crisis is far from over, bailouts have sent financial markets soaring while the real economy is still in pain. The result is two overlapping rhythms that make it even more difficult for investors to navigate. If the economic cycle is the big picture, then the corporate profit cycle is a close-up of each color in that picture. Profits do not go in a straight line. They fluctuate with changes in the economy, consumer demand, production costs, competition and technological innovation as the economy expands. Sales increase, fixed costs are spread over larger output, profits soar, vice versa in recession. Sales are down, costs cannot shrink immediately. Profits plummeted. The profit cycle is also exaggerated by corporate management psychology. When profits grow, companies are optimistic about expanding production, borrowing more capital, and investing in factories. But at that time costs increased, competition was fierce, and profit margins were decreasing. Then when profits shrink, management cuts investments, downsizes operations, and those actions create the conditions for profits to recover in the future. In other words, profits are also cyclical, and it is the actions of the business that contribute to making them stronger. A typical example is the airline industry. When demand for flights is high, airlines compete to buy new planes and open more routes, ticket prices decrease due to competition and profits decrease despite the high passenger volume. Then when the market goes down, many airlines go bankrupt, fleets shrink, competition lessens, fares go back up, profits recover, and the cycle repeats itself. For investors, identifying the profit cycle is key. When earnings are at their peak, valuations are often inflated and the risks are much higher than they appear. When earnings are down, the market is pessimistic, valuations are low, it can be such an opportunity. From the economy to corporate profits, from macro policies to micro decisions, everything moves in repetitive rhythms. The difference is only who is sober enough to realize and patient enough to act against the crowd. If there is a cycle that is the most powerful and has the most profound influence on the financial markets, it is the investor psychology cycle. Because in the end, every price in the market reflects not only profits or economics but also emotions and beliefs. I often describe that mentality as a pendulum. It rarely stops at the point of balance where reason and sanity reign. Instead, it constantly swings from one extreme to another, from optimism to pessimism, from greed to fear, from to despair. And it is this volatility that creates the greatest opportunities and dangers for investors. When the pendulum swings toward greed, investors see only bright futures. They believe that prices will rise forever, that this time is different, that the old rules no longer apply. In such times, people are willing to pay any price, taking risks as a matter of course, resulting in overvalued assets and risks accumulating like time bombs. Conversely, when the pendulum tilts toward fear, the outlook becomes darker. Investors believe that everything will collapse, that the risk is unacceptable. Asset prices are sold off below their real value. But in that darkness, opportunity appears for those brave enough to look beyond fear. The important thing is that the psychological pendulum never stands still. It rarely stops at the right balance point. Because humans are inherently governed by emotions. When the market is good, few can remain cautious. When the market is bad, few can remain optimistic. And so we always fluctuate around reason. But very rarely in the middle. Graham, Warren Buffett's teacher, said the market in the short term is a voting machine, in the long term is a weighing machine. In the short term, prices only reflect mass psychology, who is more optimistic, who is more pessimistic. Only in the long run will prices return to reflect real value. But between those 2 points, the psychological pendulum decides the course, and sometimes it pulls the market very far from reality. Look at the history of .com in the late 1990s. Investors believed the internet would change everything, but they also believed that any company with a .com on it was worth billions of dollars. Extreme euphoria has sent tech stocks skyrocketing. Then just a few years later, the pendulum swung, companies went bankrupt, markets crashed, and confidence disappeared. But it was also at this time that truly valuable businesses like Mason began their journey to the top, or the financial crisis of 2008. Before that, the credit market was dominated by blind optimism. People believe that real estate never loses value, that borrowing is safe. The pendulum swings heavily towards greed. When the bubble burst, the mood turned to extreme fear. People believed that the financial system was going to collapse, that there was no hope. And right at that moment, the opportunity for a new generation of investors was born. The psychological cycle is not just a part of the market, it is the heart of the market. The question is how to deal with this pendulum. The answer doesn't lie in predicting exactly when it will reverse. That is impossible. But we can recognize when it has gone too far, when excitement becomes dangerous. And when fear opens up opportunity, I often remind colleagues, when everyone agrees that risk is low, it is actually at its highest. Conversely, when everyone believes that the risk is unbearable, the risk is absorbed into the price and the profit potential increases. This leads us to a key truth. Successful investing doesn't come from following the crowd, it comes from recognizing where the pendulum is and daring to act against it. When others are too greedy, be careful. When others are too afraid, be brave. The psychological cycle is the end of the part-wide journey because it ties together everything we've talked about: economics, profits, policy. Everything only becomes real in the market when filtered through human emotions, and there it is. Opportunities and dangers go hand in hand. Part 2, profit, which seems to be the most objective number in business, cannot escape the repeating rhythm of the cycle. It is often assumed that if the economy is improving, profits will steadily improve. If the economy goes down, profits simply fall, but the reality is much more complicated. Profits not only go along with the economy but also fluctuate more strongly than the economy, like an echo is much louder than the original sound. The reason lies in the operating leverage when revenue increases. Fixed costs are spread over a larger volume of output. Profit margins skyrocketed. A manufacturing company with a factory and machinery already equipped can produce thousands more products at low marginal cost. Revenue inched up but profits jumped. Conversely, when revenue decreases, fixed costs remain unchanged, causing profits to fall sharply, even faster than revenue. That is why economic growth cycles become more brilliant and recessions more brutal. During the expansion phase, businesses benefit from the combination of strong demand and stable costs, resulting in rapid profits. Financial reports are beautiful, investors are happy. But it was then that the seeds of decline were sown, new competitors entered, production capacity expanded, and labor and raw material costs escalated. What was once an advantage has now become a burden. When the economy slows, revenue shrinks but expenses hardly follow. Fixed expenses such as depreciation, rent, and interest still have to be paid. Profit margins are falling rapidly. Sometimes negative returns, and like every other cycle. This decline not only reflects the current situation but also creates conditions for a subsequent recovery. One of the biggest paradoxes I've ever seen is that the highest returns often occur right before a recession and the lowest returns right before a recovery. It's not a joke of fate but inevitable logic. When profits peak, everyone is fully expanded. Prices are climbing, competition is fierce, there is no more room for growth, the pendulum inevitably turns. When profits hit rock bottom, businesses cut back, excess capacity was purged, and prices fell to attractive levels. The conditions for recovery are ready. This is why profits are not a perfect indicator of the future. When it's at its best, the risks can be greatest, when it's at its worst, the opportunities open up. But most people fall into the opposite trap. Buy when profits are certain and sell when profits are bad. Look at heavy industry or transportation. When demand booms, factories run at full capacity, profits are high. But then in that euphoria, they built more factories, ordered more ships, and took on more debt until demand weakened. Oversupply keeps borrowing costs low, profits evaporate, cycle repeats. Profit is a magnifying glass of the economy. It shows that people are susceptible to short-term number illusions. While true nature lies in long-term rhythm, too high will lead to deep down, extreme darkness will give way to light. When we look more closely at the profit cycle, we realize that it is not just a result of general economics or operating leverage, it is also shaped by competition. An invisible but fierce force that makes profit margins never stand still. In prosperous times, when profits are high, businesses cannot sit still, expansion becomes the watchword, factories spring up, workers are hired, loans are boosted, one company's success quickly attracts competitors, mass participation overwhelms supply and seemingly sustainable profits begin to thin. It was then that the seeds of decline were quietly forming, in contrast to the recession. When profits fall, businesses reduce production, cut costs, many companies even go bankrupt, as a result competition is reduced. Supply is limited, cost level is lowered. This is the condition for profits to recover when others give up. The patient will stay and reap. A classic example is the airline industry where demand for flights increases. Airlines compete to order new planes, open more routes in the short term, revenue increases, profits explode. But that boom brought with it an arms race, bloated fleets, and fierce price competition. And just a few years later, profits plummeted again. Then when the recession hits, many airlines can't bear the huge costs, go bankrupt or merge, the market shrinks, fares go up, profits return and the cycle continues. The scary thing here is blindness to the recent past. When profits are high, it is believed that it will last forever, when profits are low. Despair made them think that the light would never return. But history has proven that the cycle always operates, just at different speeds and degrees. This has an important consequence. Extreme returns are often warning signals, while extreme returns are often signs of opportunity. But human psychology causes most investors to act the opposite. They pour money in when the financial reports are glowing and run away when the numbers are bad. In fact, when profits are high, stock valuations are also inflated. People see the current figure as the new norm, not realizing that such a level of profitability is difficult to maintain. Conversely, when earnings are low, stock prices often reflect extreme pessimism. And if investors can see through the veil, they will see a rare opportunity. In other words, profit is not only the result of the cycle but also its engine. As businesses reap the rewards, they sow the seeds for competition and rising costs. When they fail, it is the very shrinking that creates the ground for further success. For investors, understanding the earnings cycle means not letting current numbers blind you, but putting them into context. One has to wonder if this is the peak of euphoria or the bottom of decline. Only by doing that can we avoid the trap of the majority and make our own way in the investment world. Psychology and attitude towards risk are two sides of the same coin. They operate like two large branches of an emotional pendulum, always swinging from one extreme to the other. When the market is excited, optimism prevails. Investors believe that risk has almost disappeared. They are willing to pay high prices for any property because they believe that the future will be bright forever. The familiar phrases appear, this time different, the old rules no longer hold. Growth will not stop. In those moments, the risk seems to be lowest, but because people believe the risk is low, they act carelessly and that makes the real risk highest. Conversely, when fear prevails, investors see only darkness. They believe that risk is unacceptable, that all investments are dangerous, that markets are in a sell-off, and that asset prices are falling below their true value. But then the real risk is low because it is already absorbed into the price. Here we see an important paradox. Risk is not measured by numbers but by human behavior. When people think the risk is low, they often unintentionally make it high. When they believe the risk is high, their defensive actions make the market safer for those brave enough. This explains why investor sentiment and risk appetite go in cycles. When recent profits are good, they believe that the risk has disappeared, and are willing to borrow and invest recklessly. When profits are bad, they tighten standards, refuse to lend, and withdraw capital even from healthy opportunities. Attitude towards risk directly affects the cost of capital. When sentiment is euphoric, standards are loose, capital becomes cheap and people rush to invest. That pushes up asset valuations, eroding future profits. When sentiment is pessimistic, standards are strict, capital becomes expensive, few people dare to borrow, asset prices fall to low levels, future profits become attractive. It can be seen that risk attitudes operate as a self-amplifying spiral. Optimism creates relaxed behavior. Loosening creates more investment creates virtual profits. Profits further fuel optimism. When the spiral breaks, pessimism grips everyone tightly. Tightening causes lack of capital. Lack of capital deepens recession, recession breeds pessimism. For the savvy investor, this is a golden opportunity to go against the tide. When the crowd believes that risk disappears, it is time to be cautious. When the crowd thinks the risk is too great, that's the time to be brave. But going back is never easy. It requires a deep understanding of psychological cycles and, most of all, the courage to act differently. History has shown that the biggest profits go to those who buy when others are fearful and sell when others are enthusiastic. I realize that psychology and risk are not just side factors of the market, they are the core because every cycle, economic, profit, credit is ultimately filtered through the lens of human psychology, it is how people perceive risk that determines the flow of capital, and that flow in turn nourishes or chokes the next cycle. Once you understand this, you will see that it is not important to measure risk using models or statistics. It is important to have a sense of where the psychological pendulum is, and that sense, if cultivated, can become an investor's most sustainable competitive advantage across all cycles. The credit cycle is perhaps the most powerful force driving the peaks and troughs of financial markets. Because credit is the lifeblood of the system. When the flow is smooth, all activities expand. When there is a blockage, the whole economic body is shaken. The familiar starting point of the credit cycle is when the credit window opens wide. During this period, capital seemed limitless, banks and investors were willing to lend, willing to buy anything that was issued, and underwriting standards were relaxed. The previous strict conditions disappeared, and borrowers with poor credit were still provided with loans. Companies with weak balance sheets can still issue bonds, and even risky deals can be financed. The cause begins with optimism. When the economy and profits are rising, default rates are low. Investors believe the risk has disappeared. They look at recent data and conclude, we live in unprecedented times. As a result, they are willing to accept lower interest rates and more lenient terms. Interestingly, it is precisely when people believe the risk is low that they create the highest risk environment. When capital is cheap and abundant, it is allocated haphazardly, funding weak projects, incompetent companies, and deals that survive only on blind faith. Such loans are bound to explode when circumstances change. During the credit expansion period, borrowers benefit in all ways. They can raise capital at low cost, extend maturities, and even add debt without questions being asked. Weak businesses have a chance to survive, even to grow. Huge mergers and acquisitions are on the horizon. It all rests on the assumption that cheap capital will last forever. But history shows that periods of easy credit always end in pain. Because too much money is lent with too low standards. Risks accumulate, just one economic hit, a drop in profits, a rise in interest rates, or just a high-profile default, and the whole system begins to doubt. And as doubt spread, the wide-open credit door suddenly slammed shut. Those who lived through the 2008 financial crisis cannot forget this image. Before that, subprime credit was issued massively and securitization was rampant. The standard is almost zero. Financial institutions believe that all risk is dispersed, but in fact the risk is only hidden. When the bubble burst, a series of weak debt-financed assets emerged and the entire system nearly collapsed. But we don't need a far-fetched example anytime soon. When you see investors accepting unusually low yields, when loan terms are unreasonably easy, know that the credit cycle is on its dangerous side. That's when the risk is highest. Even when everything seems peaceful on the surface. It is important to emphasize that credit cycles are not determined by mathematical models but by human emotions. Optimism leads to generosity, generosity leads to misallocation. Misallocation leads to loss, loss leads to pessimism, and pessimism makes credit tight. Then the cycle starts again. In this early stage, when credit opens up, everyone feels like they are winning. Borrowers get cheap capital, lenders get fees and seemingly reasonable interest rates. The stock market also boomed as cheap capital inflated valuations. But it was short-term prosperity built on fragile foundations. That's why I always remind. Look at the attitude of the credit market. It is a more honest indicator than the stock market. When credit expands too much, you know the seeds of decline are there. When the credit window closes, the picture becomes completely different. If in the previous stage it flowed like a flood, now it has shrunk into scarce drops. Loans that were once easy have disappeared or come with suffocatingly strict conditions. During this period, fear spread, lenders remember the losses. They become wary, even suspicious, of customers once considered safe. Credit standards are tightened, borrowers with good balance sheets are still being turned away. New bond and stock issuances have failed en masse, and even viable projects have been put on hold due to a lack of funding. As a result, the economy, which relied on credit flow, immediately stagnated, businesses could not expand and even had to shrink. Weak companies that survived on cheap debt now have no choice but to go bankrupt. Pessimism further tightens the cycle. Lenders seeing defaults increase shrink further, increasing risk. However, for the astute investor, the credit crunch is when opportunities open up. When few are willing to provide capital, those who remain have the power to set the terms. This is when yields are high, assets are undervalued, and buyers can negotiate from a position of strength. In the cold of fear, the seeds of future profits are sown. This creates a familiar market paradox. When credit is easiest, risk is highest, and when credit is tight, opportunity is greatest. But most investors are attracted by appearance. They rejoice when credit opens and panic when it closes. It is this reversal of perception that gives an advantage to those who see differently. The credit cycle is thus like the breath of the market. Inhale too deeply, exhale forcefully. Exhale too long and eventually inhale again. No one knows exactly when the transition will occur, but the signals are clear: interest rates are unusually low. Easy loan terms are a sign of a peak, capital shortage. Tight lending conditions are a sign of bottom. Historically, every recession has been marked by a credit squeeze. The 2008 subprime mortgage collapse is a prime example. But not an exception. Before that was the Latin American debt crisis of the 1980s or the Asian crisis of the late 1990s. Each time the pattern was the same: excessive credit expansion, capital misallocation, bubbles forming. Then when the bubble burst, credit was withdrawn suddenly, causing a chain reaction of failures. When you understand it, you will see that the credit cycle is the strongest projection of human psychology onto the market. It starts with overconfidence, moves through indulgence, ends with extreme fear, and then returns to balance. The cool observer would not ask whether credit is opening or closing. They will ask themselves, where are we on this pendulum axis and what is reasonable behavior? Because in investing you should not always go with the flow. There are times to step back when the crowd charges and times to step forward when they run. The credit cycle with its openings and closings is the stage where courage and insight are most severely tested in the financial world. There is a particularly vicious cycle where participants can fall from the pinnacle of power to the depths of bankruptcy in just a few years: the bad debt cycle. Its sequence repeats itself like a pre-written tragedy. Initially there was a release boom. When credit is easy, companies borrow heavily, bonds are sold, capital flows to even weak businesses, buyers do not hesitate, as long as the interest rate seems attractive. Next comes the loss of quality. When capital needs are easily met, standards are relaxed. Risky loans also easily slip through the door. Then the economy took a turn for the worse, sales fell, and borrowing costs became prohibitive. Many companies are no longer able to pay their debts, and defaults are skyrocketing. At this time, buyers withdrew and the bond market almost froze. No one wants to touch burning properties, prices have fallen miserably. Bonds that used to sell for 100 are now selling for 40, 30, or even 10. Investors panicked and fled at all costs. Then comes the restructuring phase: some companies go bankrupt, some renegotiate with creditors, converting debt into equity. Once worthless debt suddenly becomes an opportunity for new buyers. Eventually, as the economy recovered, junk bonds came back to life. Prices rise again, buyers rush back in, and the cycle starts all over again. What is remarkable about the bad debt cycle is that it exposes the causal nature most clearly. Each link leads directly to the next. The ease of credit spawned massive issuance. Mass release leads to quality decline. Poor quality economic crisis will create bankruptcy. Defaults cause buyers to pull out. Buyers withdrew, pushing prices to the bottom. The bottom price opens the way for a rebuilding opportunity. All are connected in a chain that cannot be cut apart. For investors, bad debt is a harsh but also promising playground. When the market is at bottom, whoever is brave enough to buy will reap huge profits when the recovery comes. But it requires not only courage but also careful analysis to distinguish between companies that can be revived and those that are destined to disappear. If the bad debt cycle shows the fragility of debt, the real estate cycle shows the stubbornness of material supply and demand. Real estate is particularly sensitive to credit. To build a building or urban area, one needs huge capital and a long time during the boom period. Cheap credit projects boom, but unlike stocks that can be issued immediately, real estate takes years to complete. As the project entered the market, demand changed and oversupply emerged, the familiar pattern repeating itself. When housing prices rise, everyone believes they will rise forever. Home buyers borrow, developers borrow to build new. Banks compete with each other to offer mortgage loans. But at that moment the bubble quietly inflated. When interest rates rise or the economy slows, demand retreats. Unfinished projects in Zhang became a burden, excess supply caused prices to plummet, fear spread, banks suffered bad debts, buyers lost confidence, and projects were abandoned. Prices fall below construction costs. Then, like every other cycle, extreme pessimism opens up opportunities when few dare to invest. Patient buyers can buy properties for less than replacement cost. And when demand recovers, real estate returns, huge profits appear. The real estate cycle is also special in that it has a very large lag. A project can take 35 years from start to completion. This causes supply to often exceed demand just when the market no longer needs more, and vice versa, there is a shortage of supply when the market recovers. This slowdown makes real estate one of the strongest cyclical markets. From a bird's eye view, both bad debt and real estate reflect a common principle. People always forget the cycle in excitement. They think success will last forever and borrow excessively in desperation. They think failure is permanent and give up even when opportunities are emerging for the sane investor. The lessons from these two cycles are clear. Be doubtful when all believe and be courageous when all flee. Because it is at those two poles that destiny is shaped after going through each link of profit, psychology, risk attitude, credit, bad debt, and real estate. We see clearly that no cycle exists independently. They are interconnected, nourish each other, and together create a greater rhythm. Market cycle. This is not a machine that operates on a rigid formula. On the contrary, it is the sum of many forces. Sometimes in phase, sometimes out of phase. But the common point is that they all swing from one extreme to another. And it is this oscillation that paints the peaks and troughs that investors face as the economy grows, corporate profits boom, sentiment is buoyant, risk appetite is loose, credit is open, real estate is vibrant, all resonate to push the market higher. In that moment, it seemed like no force could stop it, but that very resonance sowed the seeds for the reversal. When one factor changes direction, profits stagnate, credit tightens or real estate is oversupplied, the whole chain starts to react and the market turns around. On the contrary, in a recession, everything is gloomy, profits decline, sentiment is pessimistic, risks are inflated, credit freezes, and real estate plummets. People see only collapse, believing that the future is extremely dark. But when everything is at its worst, the market is poised to rally because there is nothing left to lose. Cheap, risk-absorbed and each link in the chain begins to reverse direction. One important point to remember, market cycles cannot be predicted with exact timing. No one knows exactly when the market will peak or bottom. But we don't need that. What we need is to recognize the extreme state. When people are too optimistic, when they are too pessimistic, to recognize the extreme, we don't need a clock, just a compass. This is why I emphasize. Act on what the environment is revealing. No need to play the role of fairy. When credit is too easy, be defensive. When returns are unreasonably high, be wary of real estate hype. Be skeptical, on the contrary, when defaults are rampant, when sentiment is gloomy, when credit is tight, when real estate is abandoned, it may be an opportunity to prepare to strike. The bottom line is that the facts speak enough for the behavior to be taken. No need to forecast inflation next year or GDP next quarter, just observe whether credit is open or closed now, whether sentiment is inclined towards greed or fear, whether profits are expanding or contracting. What we see today already contains hints for tomorrow. Of course, no one can be right all the time, but success in investing does not require omnipotence. It just takes one thing to tilt the odds in its favor. If you avoid big mistakes when the market is too hot and take advantage of a few opportunities when the market is too cold, you will be far ahead of the majority when looking back at history. From Bonbon. Calm to the financial crisis, from the real estate cycle to the credit cycle, we see a familiar refrain. Everything will turn around. The market is never at the top forever, nor is it at the bottom forever. The only difference is whether you are prepared to go against the crowd or get swept up in the general psychological pendulum. The market cycle is therefore not the enemy, it is the map. A loser is someone who blindly chases short-term waves. A successful person is one who can read the map, knows that every extreme signals a turning point, and dares to act accordingly. And that is the art of not spending money, just observing and preparing. Third, the first thing I must emphasize is that no one can accurately predict the peaks and troughs of the cycle. The market is not a clockwork machine, it does not operate at a regular rhythm that we can set a timer for instead of dreaming about knowing tomorrow. What is more practical is learning to deal wisely with the cycle. The greatest danger comes from the belief that someone can foresee the future. How many economists, investors, central banks have been confident in their judgments and then wrong. Historical statistics show that most macro forecasts are useless, even when someone is right. Usually it's just chance and not a repeatable skill. So what can we do? The answer lies in giving up the predictive illusion. Pay attention to observation instead. Instead of asking when the recession will happen, we should ask where the market is currently on the cycle axis. Because only by recognizing our current state can we adjust our behavior to tilt the odds in our favor. It is important to emphasize here that dealing with cycles is not an emotional act of impulse but a process of observing extreme signals. For example, when credit is too easy, when valuations far exceed real values, when crowd psychology is filled with euphoria, these are signs of danger. Conversely, when defaults are widespread, when investors are extremely pessimistic, when asset prices are sold off, it is a sign of opportunity. In practice, this means that it is not necessary to know exactly whether today is a top or a bottom, but we can recognize when the risk is tilted to one side. And by simply adjusting our portfolio accordingly, we are already one step ahead of the crowd. Remember the late 1990s stock market bubble back then? No one can say exactly when the market will crash, but the signs of a peak are clear: irrational valuations. Unprofitable companies are still being praised. The mentality that the internet will eliminate all cycles. A sane person does not need to predict the day of collapse, just understand that the risk is too great and reduce participation. Conversely, after the bubble bursts, the good companies that survive become great opportunities for the patient. This is the difference. Prediction is the art of arrogance, observation is the art of humility. Capital markets are always unpredictable and we cannot control it. But we can control our reaction when the market gets hot. We can choose to stand back. When the market is cold, we can take a step forward. Such behavior does not require genius, only patience and discipline. More importantly, don't believe you need to be 100% right. No one can do that. Success in investing is not about calling every top and bottom, but about avoiding big mistakes and taking advantage of a few obvious opportunities. If you know how to stand aside when the crowd is losing its mind and dare to step in when they are most afraid, you are far ahead of the rest. So dealing with cycles means observing extremes, adjusting strategies, and accepting uncertainty. It's not as flashy as claiming to predict the exact date of the recession, but it's sustainable, humble, and realistic. And in the investment world, that is the reliable way. Dealing with cycles does not require us to become prophets. It requires a more modest but much more important skill. Peak signal recognition. The tops and bottoms of the cycle never have signs. But they leave clear clues for anyone who cares to observe. Let me recount the familiar signals. When the market is on the dangerous side, you will see valuations that are way above historical standards, with price-earnings, and price-to-earnings ratios pushed to absurd levels. It is argued that the new model will make old standards obsolete and credit will be easy. Banks do not require collateral for loans. Huge loan deals funded in a flash. The issuer sets the conditions, the buyer accepts unconditionally. The crowd was in a frenzy, believing that the risk had passed. The catchphrase is that everything will continue to be fine. Any warnings were dismissed as unwarranted pessimism. Conversely, when the market is on the side of opportunity, you will see valuations fall to rare lows, stocks being sold off below their intrinsic value. Real estate is for sale cheaper than the cost of construction. Credit is tight, banks refuse to lend even to good customers. The primary bond market is almost frozen, sentiment is pessimistic. The crowd believes the risk is unbearable. It was thought that this collapse would last forever. Any call for opportunity is considered an illusion. In both cases, it is important not to wait for absolute certainty. By the time the peak is widely recognized, it is past. When the bottom is reached, everyone confirms that the opportunity has passed. Investors must act when there is ambiguity, when the evidence is incomplete. But the climax signal is clear. Think back to the 2008 crisis. Before the bubble burst, U.S. real estate valuations were skyrocketing, subprime lending was rampant, and bull sentiment was everywhere. The signs of the climax are there, just few dare to believe. And after the crisis hits, when housing prices are in free fall, when banks are failing, when people believe the system is collapsing forever, that's when the other extreme forms. Opening up opportunities for those who are brave enough. Dealing wisely with cycles is the art of adjusting attitudes. It doesn't require you to withdraw all your capital as soon as the market is hot or put all your money in as soon as the market is cold. It requires you to tip the scales. Add defense when risk increases, add offense when opportunity opens. During the excitement phase, what can defenses be? Keep more cash, choose safer assets, reduce exposure and risky investments during bearish times. What could the attack be? Buy more good stocks when they are undervalued. Expand positions in quality assets that have been sold off. The key. Adjust behavior to current environment. You don't need to predict tomorrow, just observe today. You already know which side you should lean towards. There will always be people in the market who want to predict tomorrow and they will always be in the spotlight for their dramatic predictions. But history proves that it is the one who observes the present who has a lasting advantage. They are not geniuses but they are patient, cautious and dare to act against the crowd. The conclusion here is clear, cycles cannot be controlled but can be managed with the right attitude. And that attitude is the difference between an investor who gets carried away by the market and an investor who knows how to use the cycle as an ally. In investing it is not always necessary to look for absolute opportunities. In fact, much of the success comes from positioning correctly in the cycle. Know when to defend and when to attack. Imagine the market as a vast battlefield. No one can completely avoid the arrows flying randomly. But a wise warrior always knows when to hide behind his shield and when to draw his sword and charge. For investors, the shield is defense, and the sword is offense. In times when the cycle is tilted towards risk, it makes the most sense to increase defense. Defense does not mean running away from the market but adjusting the way of participation, keeping a higher proportion of cash to have room to react, choosing safer assets. Prioritize businesses with strong balance sheets and stable cash flows, reduce exposure to high-risk investments, hot stocks, high-yield but poor-quality bonds, or deals that rely too heavily on leverage. Conversely, in periods of extreme market pessimism, valuations are compressed to unreasonable levels, and attacking is the wise course of action. Attacking does not mean being reckless, but daring to buy when the crowd is running away, daring to expand positions when prices are so cheap that the opportunities far outweigh the risks. The key here is not knowing exactly whether today is a top or a bottom. Just recognize which end of the pendulum we are near. If the market is already overheated, without waiting for more evidence, lean defensive. If the market is too cold, without waiting for anyone to confirm, lean towards attacking. This sounds simple but is actually one of the biggest challenges. Because people are influenced by crowd psychology when the market is going up. The sense of security fools us into thinking that the risk is gone, making us want to attack more when the market is going down. Fear makes us cower, even when it may be time to attack. Success in cycle positioning does not come from superior intelligence but from discipline and the courage to go against the flow. It takes patience to defend when people are rejoicing. It takes courage to attack when people are desperate. I have seen many investors fail not because they lack knowledge but because they are positioned wrongly in the cycle. They attack when the market is too expensive and defend when the market is too cheap. On the contrary, the most successful people I know all have one thing in common. They know how to tip the scales at the right time. Cycle positioning is not a guessing game but the art of looking directly at current reality and accepting what it shows even when it conflicts with your emotions. Positioning in the cycle is not an all-in game. It is not about withdrawing everything when defending, nor is it about going all in when attacking. It's like turning a steering wheel, just gradually adjusting towards safer or riskier directions depending on the environment. In a bull market, when valuations are high, credit is easy, and sentiment is frenzied, the wise move is not to run away but to slow down. You can keep a lower than normal exposure to stocks, increase your exposure to quality bonds, or simply keep more cash. This doesn't completely avoid the risk when a reversal occurs, but it does help you reduce your losses and have ammunition ready for the opportunity behind. Conversely, during periods of market pessimism, when assets are sold off, credit is frozen, and valuations are unreasonably cheap. This is the time to tip the scales to attack. But going on the offensive doesn't mean going on a reckless buying spree. It means being selective, finding solid businesses. Quality assets are undervalued simply because of general fear. That way you control risk while taking advantage. It's important to emphasize that positioning never needs to be absolutely precise. You don't have to pick the exact day the market tops or bottoms, you just have to adjust your position accordingly. Be more defensive when danger increases, more aggressive when opportunity opens up, and over time the results will far outweigh the majority. In fact, it's like driving on a roundabout. You can't know exactly how many meters the next corner is, but just realizing that you're entering a corner will slow you down. When you see a straight stretch of road open up, you accelerate. Successful investors do the same thing with cycles. Not measuring exactly but tilt the steering wheel in the right direction. One important point, cycle positioning must always be accompanied by humility. The biggest mistake investors make is believing they have the market figured out. In reality, we can only tilt the odds in our favor, but never eliminate the risk. When you apply this thinking to portfolio management, you will find that during hot periods, short-term returns can be lower because you are not following the crowd. But when the shock comes, you avoid big losses and still have capital to buy in. During the cold phase, you may incur temporary losses by buying in the midst of fear. But when the market recovers, the excess profits will come to you. Time will prove the value of correct positioning. Even in the short term, it makes you feel lonely. The great investors I have known are not the ones who are always right in their predictions, but the ones who know how to balance defense and offense. They don't let excitement get the better of them, nor do they let fear get in the way of opportunity. And it is that flexibility that creates sustainable, cyclical positioning advantage. Ultimately it's not a short-term strategy, it's an investment philosophy. Learn to accept uncertainty, adjust your attitude, and know that being on the right side of the pendulum is much more important than catching each swing correctly. When it comes to dealing with periods, I have to be honest. There are limits that cannot be crossed. No matter how closely you observe, how badly you analyze, you cannot completely escape the influence of cycles. One of the obvious limitations is that no one is immune to mistakes. Humans are driven by emotions, even if you know the theory of cycles. In fact, while the crowd is euphoric, you will still feel caught up in the market crash. You will still feel anxious like anyone else. Knowledge only helps us reduce mistakes but never eliminate them completely. Second, no one can guess right all the time. Positioning within the cycle only gives us a probability advantage, not certainty. Sometimes you defend too early, the market continues to go up for a while. Sometimes you attack too early, the market still falls further. This is inevitable and it is the price to pay for maintaining a long-term advantage. Third, the investment environment is always changing. Some tools that were once useful may become ineffective in the new context. Some signals that were once reliable may become noisy. The cycle is repetitive in nature but the details are not. That means there is no permanent formula. Therefore, dealing with cycles requires humility. The failure of many investors comes from the illusion that they have found the master key to controlling the market. But the market always finds a way to prove that no one can control it when you believe you are immune. That's when you're most vulnerable. Another limitation comes from the very nature of investing. You can't stay out forever if you're too defensive. Waiting for the perfect opportunity. You may miss out on a long growth period if you are too aggressive. Believe that you will escape in time before the cycle turns around. You will be stuck when the market turns faster than you think. So what is the right attitude? It's accepting uncertainty as part of the game. No one can avoid all risks, nor can anyone choose all opportunities. What we can do is lean towards rationality, adjust as circumstances change, and most importantly, avoid fatal mistakes in investing. No need to be always right, just avoid being wrong and dealing a fatal blow. A large capital loss in one bad cycle can wipe out years of gains. But if you keep your perseverance, get through many cycles without getting knocked down, then just a few times taking advantage of big opportunities, success will come. The limits of dealing with cycles are not failures but realities that need to be acknowledged. Accepting this limitation helps us to be calmer, not delusional, not arrogant. Investors are not conquerors of the cycle but companions with it. Know how to be humble, know how to adjust, know how to be patient. That is real power. Cycles are not only present in economics, credit or crowd psychology, they are also deeply embedded in the success of people and organizations. This is one of the most subtle cycles. Because it takes place internally and behaviorally but the impact is no less powerful. The familiar pattern goes like this: success breeds confidence. Confidence, if left unchecked, turns into complacency. Complacency leads to mistakes, subjectivity, underestimation of risks or overextension. Mistakes inevitably lead to failure. But failure, if viewed properly, becomes a lesson that paves the way for new success. This is the cycle of success, a cycle no less cruel than the economic cycle in the investment world. Examples of this cycle abound where a fund performs brilliantly for a few years, attracts huge capital, and is hailed as a genius. Initial success led them to believe their method was invincible. They take more risks, increase leverage, expand into unfamiliar areas, and then with just one market reversal, their results evaporate, their reputation collapses, and investors flee. On a personal level as well, a young investor can get off to a lucky start, reaping huge profits during favorable market periods. Early success made him believe that he had special abilities, he took more risks, disregarded discipline and was eventually taught a bitter lesson by the market. But failure is not the end. If you are humble enough to learn, failure is the source of growth. Many of today's great investors have experienced catastrophic failure in the past. It is that experience that helps them understand their limits, avoid repeating mistakes, and build resilience. The important lesson here is that success also needs to be managed as a cycle. When success comes, know that it carries with it the seed of complacency when failure comes. Remember that it contains opportunities for learning and rebirth. This applies not only to investing but also to business and more broadly to life. A growing company must be wary of the temptation to expand too quickly. An individual at the peak of his career must be alert not to fall into arrogance. Because every peak has the potential for decline and every valley has the potential for recovery. If we see success as an end point, we will be crushed by the cycle. If we see it as part of a larger rhythm where success and failure follow each other, we will go much further. Be humble in victory, patient in defeat. It's the only way to keep from getting swept away in your own cycle. A question often asked is, can the cycle be eliminated with the advancement of technology, with ever-accumulating knowledge, with ever-sophisticated policies? Will humans finally escape this endless dance? My answer is no. Cycles are not a product of ignorance or primitive tools. It stems from human nature, from psychology, emotions, short-term memory and the perpetual swing between greed and fear. No matter how advanced we become, as long as humans participate in the market, the cycle will persist. Look back in history. After every crisis, it is claimed that the lessons are clear, that the mistakes will never be repeated but a generation later. When memory fades, the mistake returns, only in a changed form. Therefore, dreaming of eliminating the cycle is a dangerous illusion. If the cycle is permanent, the important thing is not to avoid it, but to learn to live with it. This brings us to the core essence of Essentius. That essence can be summarized in a few points. No one knows exactly what tomorrow will bring, and any specific predictions about the timing are fragile and subject to collapse. But anyone can observe the present. We can look at credit, sentiment, valuations to figure out where the cycle is. The investor's job is to identify the extremes. When you feel too excited, be defensive. When you feel pessimistic to the core, prepare to attack. Success comes from tilting the odds in your favor. You don't have to be right all the time, just avoid big mistakes and take advantage of obvious opportunities. This sounds simple but is a lifelong challenge. Because it requires us to constantly go against the crowd, against our natural instincts. When everyone is rich and happy, you have to be careful. When everyone is shaking and running away, you must stand firm. The market does not punish lack of intelligence, it punishes lack of discipline. The final message I want to leave is that cycles are the eternal rhythm of the market and of life. We can't break it. But we can learn to listen. Successful people are not those who defy the cycle, but those who move with it. When to retreat, when to advance, when to stand still patiently. If there is one secret to investing, it is preparation, adjustment and patience. As I close my journey with Mastering Market SC, I would like to extend a heartfelt thank you to you, who patiently listened and walked with me through the complex yet rhythmic rhythms of the market. Without your presence, these thoughts are just silent words, it is your attention that turns them into a living dialogue. I hope this book not only opens your eyes to economic cycles, profits, psychology, and credit, but also gives you a lens through which to view your own life, where success and failure are always like ocean waves. If you find these analyses useful, please leave a rating or a comment. Not for me to hear empty compliments but for you to re-establish your position. What touches you, what is unfinished, and what you want to dig deeper into. It is these responses that form the continuation of the book, an indispensable part. And more than that, I want to hear from you. Which book would you like to explore next? Financial markets, philosophy of history, or any other field? Each of your suggestions will be like a new door where we can step in together to reflect and recount in a way that is both erudite and intimate. Thanks again for your support. Hopefully from now on you will look at the market waves and the fluctuations of life with a calmer, more profound eye.